go across to the management at City Union Bank. Mr. N. Kamakodi, Managing Director and CEO at City Union Bank, is with us. So you have approved fundraising, the latest fundraising, but you're well capitalized, you're going strong. What does this mean in terms of fundraising? Are you going to go aggressive in terms of growth?
Basically, I just want to make the record straight. Every year we have a practice of getting the shareholders' approval for an enabling resolution for capital raising. We don't burn capital unnecessarily. As you rightly said, we have 20% capital adequacy ratio, in which almost the entire thing comes from the core Tier 1 capital only. So we had our last capital raising way back in 2017 or so. For the last 5 years, every year we are getting the shareholders' approval, but we will use it only absolutely it is necessary if at all we need it. So far, we have been fortunate that even during the COVID period, we did not have any necessity of going for any capital infusion. So the resolution, whatever we are asking for the shareholders' approval is basically an enabling resolution. And as per regulation, the approval you get from the shareholders is valid for 1 full year, that is till the next annual general body meeting. So this is purely an enabling resolution, and since we have adequate return on equity in double digits, and we are able to have our growth matching the retained capital, and that's why we are able to have a balanced capital adequacy ratio, and we will use it only when it is absolutely necessary, and we don't. It is purely an enabling resolution for which we are asking for shareholders' approval. I just want to make that very clear.
Then let's talk about the growth going ahead. We've seen credit growth picking up. We've seen Q1 indications coming from a lot of banks with YOY growth. What is your sense on the credit growth? With inflation, with MSME, with cap goods picking in, do you see a pickup in credit growth which could last for some time?
Absolutely. Basically, we had a very timid growth of credit during the COVID period, and there was also not enough confidence. Particularly for the last couple of quarters, things are becoming extremely better, and we have reached a stage when the problems of COVID are already, over. So the even if we accelerate our growth rate, since we have 20% capital adequacy ratio, we may not be requiring immediately the capital. But only thing, because of the global macros and the other oil price and expected inflation, is that the investment cycle is actually getting delayed. The data says that the total capacity utilization of the economy has reached 75% or almost to the pre-COVID level. And normally the investment cycle and overall bank credit growth starts increasing when the capacity utilization of the economy touches 85%. But because of the global uncertainties, this point, the capacity utilization is probably evading us, and the investment cycle probably is getting delayed by 1 or 2 quarters, for which all of us are waiting. But definitely things are improving, and we are able to see things getting much better. And we all are preparing ourselves for the better growth cycle to come on. And we hope for the current financial year 22-23, we should be having a growth rate somewhere between 12 to 15% is what we are factoring in.
That's great. But tell me specifically, is MSME that's going to contribute to growth?
Yes, the MSME, particularly those MSMEs which have survived the COVID shock, which means that they have a lot of potential and inherent strength, and basically the confidence of those businesses are really in a good shape, and that's why when the investment cycle basically starts picking up, we will be in a position to see much better growth rate, and next 2-3 years, once the start of the investment cycle, will definitely be good and probably compensating for whatever shocks that happened during the COVID cycle.
Right. Also wanted to understand, you're looking to grow in the non-gold business as well. What is exactly your strategy, and whether or not these are going to be secured loans or not? Because that, I'm guessing, is a market concern too.
Absolutely, almost our entire loan book is fully secured, and that's why our past track record on loss on default, if 100 rupees slips, we are able to recover about 70 rupees or so in the subsequent years. And gold also forms an important part of our secured lending. Normally, even if you had a chance to look into, we even had years when we had almost 1/3 of our total loan book was gold loan and all. Then we reduced it to single digits, and then once again it is back to 20% plus of our total overall system. We concentrate on gold lending when we feel that the risk involved in other businesses are not suiting our risk appetite. So, and basically bulk of our gold lending happens in the rural and the semi-urban area, which basically is a proxy for the agricultural lending, where we lend to both agriculturists and agricultural laborers from the rural and semi-urban market. So it had been our, with a very minimum loss on default, this had been a very, let's say, with a good return on equity business particularly. So it has compensated for the growth when the growth opportunities were not available in the other sections of the loan growth and all. So it had remained a very important part of our portfolio in the past, and whenever we have opportunities in other areas, we try to go slow on the incremental gold lending, and whenever we don't see opportunities in other areas, we give thrust to the gold lending, and that's how we have balanced our strategies in the past. So this year we expect, because last 3 years bulk of our growth basically come from the gold lending during the COVID period. And this year we feel going forward, when the capacity utilization of the economy increases and the investment cycle picks up and overall credit growth in the other MSME sector grows, probably the incremental gold loan will moderate and we will have a neutral outlook, and that is what we are expecting going forward.
Right. Just a word as far as liability management is concerned. Interest rates are increasing too fast around the world, and liability and asset durations are taking a hit. At City Union Bank, what are you trying to do to prevent any major shock in one quarter because of M2M losses or gains?
Fortunately, we have, let's say, treasury policy. We have almost seen multiple cycles on this front. Our major learning in the treasury management happened in around financial year 2004, about 18 years back, when the 10-year bond yield, let's say, started coming from even, let's say, double digits, around 12%. It came down to as low as 5%, and it started going upwards when that was when the concept of HTM and all were introduced. From that time onwards, we had been very careful in managing the overall modified duration of the AFS portfolio and all. We have been very cautious in handling this, and we hope that will be helping us on both medium to long term and all. And particularly on asset side, on loan book, bulk of our loan book is on floating rate, and that's why when during the interest rate increasing cycle, the yields get adjusted and go up. But it takes longer time for the liability side to reprice, because normally term deposits take about a year to get repriced. So typically, but in an increasing interest cycle, we may not have opportunities to book profit in the treasury, but in decreasing interest rate cycle, we will be having opportunities to book in the treasury. By managing these levers, we try to balance the overall profitability in such a way that it doesn't get affected in one quarter or so. Overall, they go in an, like say, balanced form. That is how we have managed our, like say, P&L on different multiple interest rate cycles in the past, and we hope to do the same in the future too.
All right, sir. Thank you so much, sir, for taking out time for us. Always good to get perspective from you.